futures, markets and contracts. And as a high-level remark, a lot of what we will see here should look familiar if you have followed the previous lecture on forwards. There are several sections in the curriculum on this reading, but fortunately for us, so the first 6 are simply cut-paste from level 1, so they are optional. But optional means that you need to have a general idea of this stuff, but all the material you did at level 1, it's unlikely that you will be tested on the details the way you were tested in level 1. The focus here in level 2 is on pricing and valuation of futures contracts. So that is the key section that we need to focus on. And then there's a short excerpt on the role of futures markets and exchanges. This is not even a learning objective statement. So again, I will simply read an excerpt from the summary. So the key point is section 7. All right, a summary of sections 1 through 6. If you recall from level 1, one of the favorite category of questions was to do with the difference between forwards and futures. So, Hisham, what are some of the major differences between forwards and futures? So both forward transaction and future transactions are transactions to buy and sell something in the future. The difference is that forward transactions are private, customized, so between two parties there is credit risk. Futures transactions are standardized, they are public, they are exchange traded, and there is a clearinghouse, hence we do not worry about credit risk. Another major feature, and because one of the major features of futures is that we mark to market. So on a daily basis, sometimes more often than that, sometimes slightly less often, but on a very frequent basis we mark to market. Okay, and it is that aspect of a futures contract which is going to make our life slightly interesting here, because in principle the valuation and pricing of futures is exactly similar to forwards, but the mark-to-market characteristic is going to bring about some differences. So I hope you remember what that meant. And just to make sure, what did mark-to-market mean? Exactly. So mark-to-market, actually, just to understand this, in a forward transaction, what typically happens? If we have a 6-month forward transaction, the party that wins, so to speak, gets its money at the expiration of the contract. Whereas in a future, and so let's say that the party that is winning by a huge amount. So it's good to be winning, but what's the problem with that? The problem is default risk or credit risk. With futures contracts, the party that has won a little bit on a given day gets money, so the probability or the chances of credit risk diminish substantially. Okay, there are several types of futures contracts. You can have futures contracts for treasury bills, treasury bonds, stock indices, currencies, all sorts of commodities, and so on. Okay, some of these are part of the level 2 curriculum which we will focus on. All right, before I get into the details of futures contracts and get into examples, I want to actually make a very basic concept clear, and this applies both in futures contracts as well as in forward contracts. When we talk about pricing a futures contract or a forward contract, our starting point is the spot price. All right, do you remember from the last section where we said the future price is the spot price, and then we increase the spot price based on what? Based on interest. Okay, now here is the fundamental point. The forward price or the futures price, and as a quick terminology, when we talk about forwards, the forward price, we denote that by a capital F. So this is for a forward. When we talk about futures prices, we denote them with a small or lowercase f. Okay, now just intuitively, given that you are determining the futures price and your starting point is the spot price, keep in mind that the futures price depends on the spot price, and then if there are any costs associated with holding that asset, let's say for 6 months, To come up with the futures prices, should we add costs or subtract costs? Actually, we add costs. So any costs are added and any benefits are subtracted. And what's the intuition here? When you buy an asset at spot price, isn't the interest an opportunity cost? Right? If an asset is for $10,000, when you buy that asset and hold it so you can deliver it later, the interest cost is an opportunity cost. So do you recall our most basic relationship where we said that earlier on in the forward, we said the forward price is the spot price into 1 plus R. So notice that interest is simply a cost and we are adding it. So in other words, when there is a cost, that causes the forward price to be more than the spot price, and similarly that will cause the futures price to be more than the spot price. The higher the interest cost, the higher the futures price. Okay. Now, just the way interest is an opportunity cost, what if we are talking about underlying asset where it is substantially expensive to store that asset? Okay, so we are talking about, let's say, large amounts of cotton, and given the sort of material that cotton is, it's expensive to store. So high storage costs will make the futures price higher or lower? Higher. So it's a cost. So any cost is added. Now, what if you have an asset such as a bond or a stock where you are actually getting money, getting benefit from holding that asset? So that is subtracted. Why? Because the person who has the futures contract is not benefiting. The entity that is actually holding the asset is benefiting. So if we are coming up with the futures price or the forward price, you are actually subtracting the benefit. This is the benefit of what? This is the benefit of holding the actual underlying asset. Exactly. So dividends, coupon payments, interest, etc. would all be examples of benefit which is being subtracted. So if you can remember this basic framework and avoid the temptation of subtracting a cost, because all our lives we've studied and learned that cost is minus, but in the world of futures and forwards, cost is a plus in terms of this expression. So just keep this very fundamental point in mind, and everything else is just time value of money. And buy low, sell high. All right. So rather than take you through all, the bunch of text in the curriculum, we are going to simply learn the core points, which are essentially the learning objectives, and we'll do that through the examples. So this is the first example in the non-optional or the required part. Example 1 is in the optional segment, so we don't need to do that. Consider an asset priced at $50. So is this the spot price or the futures price? So this is our spot price. The risk-free interest rate is 8%, and a futures contract on the asset expires in 45 days. And we need to answer a bunch of questions. So each question is on a slide, so let's go through this carefully. Find the appropriate futures price if the underlying asset has no storage cost, no cash flows, no convenience yield. And I'll talk about this convenience yield later, but this is the most basic relationship. So your futures price, denoted by small f, is equal to your spot price, which is 50, into 1 plus the interest rate, which is 0.08, to the power of t, which is 45 divided by 365. So this is your starting point. Notice, as I mentioned earlier, that interest is a cost, and hence because of that cost, the futures price is going to be more than the spot price. So when we crunch these numbers, we get 50.48. Okay, so this is our futures price with no costs, no benefits. Next, find the appropriate futures price if the future value of storage costs on the underlying asset at the futures expiration equals 2.25. Okay, so what do you think you'll do here? It's a cost, so you add or subtract. And notice that the way they have done it, they have already given you the future value. So effectively, all you need to do is take the number from the previous slide. So the value of the futures contract is equal to the number from the last slide, which was 50.48, and you add the future value of the storage cost. And let me just make sure you get this by adding on to this example. Let's say that rather than giving you this, giving you 2.25, what the question had, and I've seen this in other cases, so we have a 45-day futures contract. We are first told that if there is no cost, no storage cost, no other benefit, then the futures price is 50.48. We are then given this number, that what if there is a storage cost where the future value is 2.25, then we simply add the 2.25. What if you were now told that there is a $2 per week storage cost? What would you do? You would take, for all the weeks, you would take the $2, and for all these costs, you would figure out what the effective future value is and add that up. If you were told that the present value of all the costs is 6, then what would you do? You would take that present value, convert that into the future value using the interest rate given. So bottom line is that you come up with the future value of the cost and add it to the base futures price, which is calculated using only the interest rate. And again, I'm hammering in this point, any cost simply adds to the price of a futures contract. And if you need help remembering this, remember that the more, when the costs are high, then so just remember that the futures contract, the guy who is selling the asset in the future, obviously if it is expensive for him to hold the asset, that cost will be reflected in the futures or the forward contract price. Okay. Find the appropriate futures price if the future value of positive cash flows on the underlying assets equals 0.75. Is this a benefit? Okay, so this is a benefit. So now the futures price will be equal to, you start with your base number, which was 50.48. And since this is a benefit, you actually subtract the benefit and you get a futures price of 49.73. Positive cash flows, or any benefits for that matter, reduce the value of futures contracts. Okay, so that's the core point. Now, sometimes you come across this term called convenience yield. And I'm going to simply read out the one-line definition in the level 2 curriculum. Convenience yield is the non-monetary return offered by an asset when it is in short supply. Okay, now just as a side remark, in different textbooks I've seen slightly different definitions of convenience yield. So don't get confused. What is the definition that you need to use? It's the definition given in the CFA level 2 book. Even across level 1 and level 3, I've seen different definitions. So since we are doing level 2, let's focus on the definition in this book. So what is an example of a convenience yield? Let's say that you are a textile company. Okay. Isn't it convenient for you to have some extra cotton, which is your raw material, sitting with you? Okay, by having extra cotton, you reduce the probability of running out of your raw material stock, because if you run out of your raw material, then your factory will be idle and there will be all sorts of other costs. So there is some non-monetary benefit of having that asset. Okay, if you are to try and compute some sort of a yield or benefit because of having that asset, then that is called a convenience yield. Now, I doubt that you'll be asked to calculate it. You might just be on an exam, you will be given a number to use as a convenience yield. Now, if you are given that yield, will that be something that you will add or subtract? It will subtract because it's a benefit. Okay, that's the core point. Find the appropriate futures price if the future value of the net overall cost of carry on the underlying asset equals 3.55. Okay, now here is another important term. Okay, so cost of carry, essentially, or net cost of carry, you can think of as, you might have, for the cotton example that I gave, there might be some storage costs worth, let's say, storage costs with a future value of, so storage costs future value equals to $10 per ton, and there is also a benefit of $2 per ton. Okay, so one way of dealing with this is to say that your overall net cost of carry is that storage cost minus the benefit. So your net cost of carry is $8. All right, so when we talk about this net cost of carry, it simply refers to your costs net of or minus any non-monetary benefits. All right, does it make sense to simply consider this and add this as a cost? It does. So if you are given net cost of carry, just treat that as your cost and figure out the future value, add it to the futures price that you calculated purely through interest rates. All right. Find the appropriate futures price if the futures value of the net overall cost of carry on the underlying asset equals 3.55. What will you do here? So you'll take that price and simply add the 3.55, and then, which we did on the previous slide. In case you haven't figured this already, the CFA Institute loves to ask arbitrage oriented questions, so make sure you are on top of them. Using part D above, illustrate how an arbitrage transaction could be executed if the contract is trading at 60. Okay, now we'll do this, and in the process we also need to make sure we understand what to do with arbitrage. The core point when you come across an arbitrage transaction is buy low, sell high. To buy low, sell high, you need to understand what is the low and what is the high. So your actual market contract, so think of it this way. So in the market, the futures contract is at 60. Now, what about the arbitrage free amount? How do you come up with the, let's just call it the arbitrage free value for the futures contract? What is this equal to? It's going to be the 50.48 plus the 3.55, the cost of carry. So 50.48 plus 3.55 is equal to 54.03. Okay, so if this is our arbitrage free amount, this is the market. So what should we do? Harun? So we buy low, sell high. So this is where we need to be selling, and this is where we should buy. Okay, so that means effectively buy in the spot market and sell in the futures market. Okay, so effectively what we need to do then is say that, okay, we get into a contract to sell, so we are taking a short position. To take a short position, now what do we do in the spot market? We need to buy that underlying asset. Okay, so when we buy that underlying asset, how much is the underlying asset for? When we started the question, we were told that the current spot price is 50. Okay, so when we buy the asset for 50, then using, so let's say we borrowed money to buy the asset. What's the foregone interest, or the interest is? So the interest cost was 8%. So over the 1 year period, it's actually 45 days. When you apply the interest, you actually come up with the so 8% interest over the 45 days will give you this amount, plus the cost of, so plus this. So you after adding the cost of carry, you have your total cost is this, and you can then sell the asset for 60. So your arbitrage profit is 60 minus 54.03. So you make your net gain. So your net gain of 5.97. Okay, now using part A above, determine the value of a long futures contract an instant before marking to market if the previous settlement price was 49. So 2 points here. First, as with forward contracts, we again have to worry about value. But unlike forward contracts, we have mark to market, let's say, on a daily basis. And as mentioned earlier, marking to market means that we figure out who owes whom how much, and the person who owes pays the counterparty. Okay. Now, so when we mark to market, as soon as we mark to market, an instant after marking to market, what's the value of the futures contract? It's back down to 0. So just to visualize this, let's say this is time 0, and let's say that at time 1 we mark to market, and then time 2 we again mark to market. At time 0, what's the value of the futures contract? It will be 0. Let's say you are the long position, and then let's say that the underlying spot starts going up. Okay, the price of the underlying asset goes up. Do you win as the long party? Okay, so you keep winning till point 1, and as soon as you get to point 1, what will happen? Let's say that the spot price went up by 5 units. You have won by 5 units. That means the short pays you 5, and then the value of the forward contract or futures contract comes back to 0. Okay, so there isn't really too much to it. The difference is that in a forward contract we wait till the end. In a futures contract we keep settling so that the amount that one party owes another doesn't become too much. Okay, the formula that you need to know looks slightly tricky, but is quite basic. The way the curriculum expresses it, the value, this is small v represents the value of a forward contract, big T represents when the futures contract will ultimately mature. So the value is equal to the value of the final futures contract minus the value of the futures contract an instant before the account is marked to market, and then it will be 0 as soon as the account is marked to market. Okay, the value of a futures contract is the gain or loss accumulated since the contract was last marked to market. So the way you make sense of all these words is quite straightforward. Okay, let's say that using part A above, determine the value of a futures contract an instant before marking to market if the previous settlement price was 49. So the way you think about this is as follows. The previous settlement price, let's say that happened at time 0. The settlement price was 49. Now the price has become 50. Okay, now actually if the last settlement price is 49, if now the value of the futures contract is 50.48, then the value of the futures contract is simply 50.48, which is the value of the future, that small ft is the value of the futures contract. So 50.48 minus minus ft minus 1, which is the amount at the previous settlement date. So minus 49. So the value of the futures contract is simply 1.48. So just take the two numbers and subtract them. The value of the futures contract minus the previous settlement price. So that's the definition of the value of a futures contract. Okay, now next topic. This part actually you might recall from level 1 commodities, you studied it back then. Okay, just a few definitions. What does contango mean? Contango is a situation where the futures price is greater than the current spot price. So if you recall these basic pictures, if you have price on the y-axis and time on the x-axis, if your spot price, this is time 0, this is your spot price 50, if your futures prices, let's say this is a futures contract 6 months, so with an expiring in 6 months, if your futures contract, the futures price, so futures price greater than spot price, then this situation is called contango. Would you normally expect this? So if you have an asset where there are no storage costs, no benefits, would you have a contango situation? You would, because the futures price you are determining by using the spot price and then adding on the interest. Okay, so if there are no storage costs, then there will be contango. What if there are storage costs? Would you have more contango or less contango? You will have more contango. And since interest costs will always be there, and it is actually more common than not to have interest costs, so contango is actually the situation you would expect. Okay, I'm not saying that's normal, because normal has a meaning, which we will get to later. Okay, the opposite of contango is backwardation, which would be a situation like this, where the futures price is less than the spot price. So you have a curve that goes down. This is backwardation. Why might you have something like this? If the benefits of holding the underlying asset are very high, then the futures price might actually be lower than the spot price. This situation is called backwardation. Futures prices and expected spot prices. What's the difference between these two terms? Okay, the futures prices are contractual prices. So if I say in this particular example of contango, let's say that the futures price is 55. This means that I can get into a contract to buy the underlying for 55 at a given point in the future. That's a contractual price. Now, does this mean that the market in general expects the price of this asset to be 55 after 6 months? Okay, now actually I'm hearing yes and no, and that's normal. There is a debate, but on whether or not the spot price is an unbiased indicator or an unbiased measure of expected future spot prices. So the curriculum goes on the side of saying that the spot price is not necessarily the same as the expected price in the future. Okay, I'm sorry. The futures price is not the same as the expected price in the future. So if this asset happens to be a barrel of oil, a futures price of 55 means that I have a contract that I will buy this barrel of oil for 55. Does that mean that I also expect the price to be exactly 55? Not necessarily. I might expect the price to be somewhat higher or somewhat lower. Actually, the futures price is going to take into account all the costs. The reason that there would be a difference is because of risk. Okay, so the party that is committing to sell you for 55 is potentially taking a risk. Okay, so that entity is going to also get some premium or some compensation for taking a risk. So because risk is involved, the party that is being compensated for the risk will essentially ensure that the price at which they are committing to sell is different from the price that is expected in the future. Okay, all you need to understand at this point is that futures prices and expected spot prices will be in the same ballpark but are not necessarily the same. Okay, so this brings us to these final two terms, normal backwardation and normal contango. The idea is this. What was backwardation? Yeah, backwardation was future price less than spot price. With normal backwardation, we are just taking this one step further, and we are saying that, let's say that this is our futures price. If the futures price is less than the expected spot price, then we have normal backwardation. Are you with me? Okay, good point. So let's call this normal okay, let me just clean this up. So the backwardation graph, as correctly pointed out, should be actually, just a quick clarification. Let me write down the main point and then get to the graph, because as I'm speaking, the graph could actually be up or down. That's not the point. The point with normal backwardation is that, so you can remember it using this. If futures price is less than spot price, then you have backwardation. With normal backwardation, we are saying if the futures price is less than the expected spot price, then we have normal backwardation. So does this mean that we have to have a downward sloping graph? Not necessarily. Okay, so all this is saying is, if you are expecting the spot price to be, say, 50, and the futures price is 49, then what do you have? You have normal backwardation. What about normal contango? So what was regular contango? Futures price greater than spot price. So normal contango means future price greater than expected spot price. So the reason this is important is as follows. In general, you would expect contango. Why? Because you will always have interest costs, and typically you will have your other costs. So markets will in general be in contango unless something strange is happening. But normal backwardation versus normal contango, here you can't just predict what will happen. So the expected spot prices obviously take into account any storage costs and benefits and so on. So what you need to do is just remember these definitions. I don't think this is a huge topic in level 2 because it's not mentioned anywhere else, and this is covered in a lot of detail in level 3. So just remember these definitions and you should be in good shape.